Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So, trying to explain this FX option volatility in a very simple manner. The idea is, if you're trading spreads, you don't have to worry as much about your volatility levels. What you do have to worry about is being right or wrong in the trading, and that's what trading's all about. Occasionally, you're going to get the tailwind where volatility is moving up, and you like to buy options. That works out well, but you might get headwind if you're buying options in like the market we're in now. You're buying options, and volatility is declining. You're sort of swimming upstream. So is volatility high or low today? What do we think? Is it high or low? In fact, I'll poll the audience. Is volatility high or low today? Let's see if somebody can type pretty quickly. I'll just throw out the response. Vol, high or low? I guess we could use it in the context of CDD. I'm getting low, low, low. Everyone's saying it's low. And you know why? We're all saying it's low because where it came from. But remember, when you're trading options, you're trading the future. So if I would have polled this same audience in December, everybody would have told me that vol was low when the Canadian dollar was trading at about a 12% vol, and now it's trading at about a 9% vol. So yes, it is a lot lower than it was, but it's not a layup that it has to go higher. That's my point here. And if you have a view on the U.S. dollar Canadian, you might want to use spreads rather than just buying an option. If you're very, very confident that vol is going to increase, you probably want to buy an option, call or put. But if you're not confident in that, you might want to trade a spread. So there, it looks low there now. Same answer. Same question. Is volatility high or low based on this? Slide 85. What does everybody think? Type it in again. I'm really curious to see, what do you think now? If I ask you in this context, is it high or low? I'm getting low, I'm getting low, I'm getting low. Thank you, low. What some of you are looking at is that it might not be low or high based on, look where it came from. It came from about 7-8%, way back here. So might that happen again? It might. It might happen again. So is volatility high or low? It depends on your frame of reference. Definitely lower than where it was 12 or 15 months ago, but again, versus 27 months ago, it might actually be a little higher. Now, here's something that I want you to take away. In fact, we're going to start to, this will be a free tool on our site, fxoptions.com. We're going to have, it's called Volatility Skew, and I think this is very helpful because I often ask traders, people that are interested in the markets, what do you think of the dollar? And most U.S. dollar, most people think that the U.S. dollar is going to go much lower. But you know what? When you look at the options market, according to Vol Skew, says that if the dollar is going to get volatile, it's going to get more volatile to the upside. And think about what happened in 2008. That's exactly what happened. So this curve on slide 86, it gives you the relationship between different strike prices, volatility, and different months. So the red line is going to be the shortest dated, the yellow is going to be the intermediate, and then green and blue, longer dated options. But what this is saying is if the dollar actually rallies, it'll probably rally in a very volatile fashion, at least that's the prediction. And if it sells off, which it has been doing, it might sell off in a very quiet fashion. So these skew charts, they can help you. This is what everybody in the options market is saying. A lot of times when I'm teaching options, people say to me, Steve, what does the street think? What do the smart FX traders in London think? And the answer is, you can get this. This is free. In fact, it will be free at the FX Options site in the next couple of weeks, so you'll be able to get this kind of information. very helpful. So here are some more skew charts: the Australian dollar, the British pound, the euro. So out of these four charts, which is different? This is back to, back to taking tests in the old days. If you look at the Aussie, pound, euro, and yen, which one is different than the other three? Hoping that you'll get this. And this is helpful when you're trading. You'll notice which one has a different relationship. Thank you. The answer is thank you very much, John. The answer is the yen. So in the yen, believe it or not, most people believe that the Japanese yen, based on this chart here, based on the volatility skews, they're worried about the dollar weakening and getting volatile, meaning that at this point, if the dollar weakens any more from here, it could weaken in a very, very volatile way. And that's what that curve is showing. So the most likely move might be up, but the more unlikely move, but the more volatile one might be down. In the other charts, we're all seeing basically that the dollar might be expected to move lower, and it has been moving lower, but if it moves higher, it might move higher in a very, very jagged fashion. That's how I use these skew charts. They don't give me an actual prediction, but they give me what-if scenarios. What if it goes down? What if it goes up? What is the market predicting? So the market is predicting that the dollar against the euro, the Aussie, and the pound, if the dollar was to rally, the dollar might rally in a very volatile fashion. Against the yen, it might actually sell off in a volatile fashion. So if I'm looking at volatilities, what I might want to do, and if I'm concerned about where these volatilities are, or I really don't want to trade these vols, I really just want to have a view of, let's say, U.S. Canadian. I don't want to worry about the vol so much. Well, what I like to do is think about spread trading. Looking at the 100-106 call spread right here, my vega is basically nothing. A 4-unit change from, let's say, 13% to 9. In fact, it was trading at 13 when I built these slides, and now it's trading at 9. So I don't want to say I was a great prognosticator because it might go to 4, but 9 was a nice stop along the way. And if you had looked at the 100-106 call spread, you might not have lost any money in volatility. Now, you did lose money if you were bullish on the U.S. dollar Canadian. If you were bearish on the U.S. dollar Canadian, you actually did well here. Because if you had bought a put spread down here, if you bought the 100-106 put spread, volatility has not gone up, it's gone down, but you had no risk to volatility. So now that the currency exchange rate has moved down, let's say 3 points from 103 to 100, if you had a put spread, you did well. So I'd urge you to really consider using vertical spreads to mitigate vol risk. Someday in the future, vol will be moving easily up or easily down. When I say easily, it'll be trending. Right now we're in a more of a neutral to slowly downward trends. So you got to watch out. Remember, trends will always end.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.